Over the last month, shares of Axon Enterprise are down by as much as 35%. What's going on there? And why is it that I didn't sell or buy anything as a result of what's going on in Iran? Let's take the next couple of minutes trying to figure that out. My name is Brian Stoffel, and let's start by looking at Axon. So if we look at what Axon stock has done just over the past month ending yesterday, not including the bump from today, the stock was down by 35%. And that led many people to ask, one, why is it down by so much? And two, shouldn't this be a stock that's on sale right now? And that motivated me to do a little digging. Now, what's really interesting is that many people know that I use reverse discounted cash flow analysis to try and figure out how expensive a stock is. Now, let's do that. And let's say that we assume that Axon can get 25% free cash flow margins once they're done building out all the things that they are. And they've got a lot of things to build out. But if we assume that and we give them that free cash flow margin today, and we assume there's going to be about 2% dilution per year going forward, well, then Axon needs to grow its revenue when it was at the beginning of the month, back on March 6th, by about 24% per year over the next 10 years. Now, we'll get to whether or not 24% per year over the next 10 years is expensive or cheap in a second, but what I want to show you is in falling 35% from March 6th to April 7th, what happened was that the underlying assumption with owning shares of Axon is that now, if the company can accomplish those free cash flow margins, then revenue only needs to grow by 17% per year for 10 years. Now, you might look at 24% and 17% and say, that's not a big difference, but compounded over 10 years, it's an enormous difference. And to give some perspective on this, let's look at the revenue growth rates for Axon all the way back to 2012. And what you can see is, with a barely exception in 2014, this company has grown its revenue over 20% for a very, very long time, coming in at 34% over the last 2 years and being above 30% for the past 4 years. Now, what you see over here on the right-hand side, those are estimates. So the company is estimated to grow revenue at about 30% per year over the next 3 years. But here's something you should know about estimates. This right here shows estimates for each given year. The blue was estimates for 2024 as they changed over time. The orange for 2025, and so on and so forth. The takeaway here is that analysts were consistently revising their estimates upwards for Axon. Now, what does that actually mean? Well, let's look at this right here. On January 1st, 2024, analysts were assuming that revenue would grow by about 45% over what they knew the company had at that time over the next 2 years. That's what they were assuming, 45% growth over that time frame. But in reality, what it came in as was 78% growth of revenue. So when people ask me, okay, so they need to grow revenue by, let's say 17, let's up it to about 19%. In fact, let's go and look at what it is today. This is Axon's ticker. This is assuming we get 25% margins and a slight beat for first quarter. We'll give a 3% terminal growth rate, a 10% discount rate. So how fast does revenue need to grow now? Because the stock's up a bunch today. And what we see is that it's basically now, we'll say between 16 and 17%. Now let's add in another 2.5%, just so we have a nice round number. So if we do that, revenue needs to grow by 19% per year for 10 years to justify this stock price. If, let's say, this company hits those 30% growth targets for the next 3 years, well then in years 4 through 10, it just needs to grow at about 15% per year. But I actually think that because of what we see here, that because of those continual upward revisions, that it's actually not even going to need to be that much. It might need to be 14 or 13% per year. So I actually think this is now a very attractive stock to hold and own. Now, this is a stock that, believe it or not, I have owned since it was $22 per share. And folks who are following me have known that I've been invested in this since then. Now, I mention that because I have a program called Stock Investing Mentor, where I track all of my results. And it comes in 3 parts. One is 1 hour of live weekly training every week, Thursday at noon Eastern. 2 is full real-time access to my real-life portfolio, which accounts for about 90% of my family's net worth. And 3, 24/7 access to a private online investing community. Now, I bring that up because if you want to join, simply click the top link in the show notes below and you can get 10% off a year-long membership. However, that deal will run out on Friday, August 10th at 11:59 p.m. Now, here's the thing to know. In the Stock Investing Mentor community, a couple weeks ago, we focused very specifically on what was happening in Iran and whether or not investors should be worried or not about what was happening. And there was a much larger presentation, but I want to show you the key part. We said that these types of situations, like what's going on in Iran, can be put into 2 buckets, 2 columns. And determining which column we're in is the most important thing to determining whether or not you should be selling stocks because things are getting worse, buying them because they're actually not that bad, or just sitting tight. The left-hand column is a geopolitical event, okay? Usually these geopolitical events have short-term volatility, but they can resolve relatively quickly within weeks and months. And usually the markets do fall on these geopolitical events, but then recover within a month. Some historical examples would be like 9/11 or the first Gulf War in 1991. The left-hand column is less concerning to long-term investors. The right-hand column is much more concerning. That is where there is damage to infrastructure that can slow down the economy for a prolonged period of time, and it can take months and years to recover from it. Why? Because once you cross the threshold from the left-hand column to the right-hand column, well, then it becomes harder and harder to claw your way back. Why? Because it can trigger recessions, bear markets, stagflation. The 2 best examples of this were the 1973 oil embargo following the Yom Kippur War and the 1979 revolution in none other than Iran. And what we talked about as a community is that the Iran conflict at that time believed was inching closer to that threshold, but had not yet crossed over. What's happened today in a 2-week ceasefire is saying that we're now moving a little bit more in the direction of the left-hand column, but it's important to point out that is no guarantee that it's going to stay there. It does explain why stocks are rallying as much as they are on this news, because the more we can go to the left, the better. Now, that matters because when you stay in the left-hand column, you see what happens on the green section here, where the stock market can rebound relatively quickly, and it makes sense to hold or even add to your stocks. But if it gets into the second column, then the real problem there is that it cripples the economy, and we get the types of returns for investors like you see in the red right there. Now, to follow along and see which one are we in, there's a couple key indicators that we should pay attention to. The first is the duration of the conflict. The second is the price of crude oil. And the third is infrastructure risk. So when I talked about this in my community, I said, best case scenario is that there is a resolution or a ceasefire by the end of April. Now, we have the first signs of this now on April 8th. We don't know if it will hold, but again, that's why the markets are rallying as much as they are. When we look at infrastructure, if we just have transit being disrupted in the Strait of Hormuz, as painful as that is, not only for oil, but for the inputs for fertilizer and helium, then that can be ramped up and fixed relatively quickly. But if there's permanent destruction to infrastructure, that becomes a problem. I would say right now we're in this yellow area. I know that there was bombing on Karg Island yesterday, but the U.S. forces are being very careful not to bomb the energy infrastructure that the world needs to process the oil coming out of that region. Doesn't mean it can't move over to the right, but it hasn't gotten there quite yet. But really the biggest one is the price of oil, because it takes into account the duration risk and the infrastructure risk. And it's worth pointing out that if we can keep oil at $85 per barrel or below over a longer term horizon, then that is a manageable crisis for the global economy. But as it creeps up, it becomes more problematic. So let's put this in perspective. On January 1st, Brent crude was trading for about $62 per barrel. Just yesterday, it had crept all the way up to $117 per barrel, which is clearly problematic if it stays there for a prolonged period of time. But today, it dropped down to about $94 per barrel. Again, I don't think it makes sense to go along making huge changes to your portfolio based on these wild gyrations. But it is important to keep the mental model of, are we in column 1 or column 2? Because once we get into column 2, you at least need to mentally prepare for what you're going to do if that happens. So those are my thoughts on both Axon Enterprise, which I do think has an attractive price today, and kind of how I'm approaching what is happening in the Middle East. Let me know what you think of both of those things in the comments section below, and don't forget to hit subscribe for any updates on this as it comes along. Until next time, Brian.